All right. Welcome to the Big Skinny with me, Lou Basenese, kicking off this March Madness in my Gator gear. Go Gators. I got to tell you what, though, the markets have been acting like chomping gators with volatility everywhere, prices up and down, especially in the oil space. We're talking about that and more, including UFOs. I know, how in the world does that tie into the markets? You'll find out as long as you stay tuned in for the rest of this episode. But at the end of the day, we're really trying to focus on how can you find profit opportunities amidst the panic, because everyone's running for the sidelines when they should be looking for the value, the bargains, the opportunity in the chaos. And I'm thankful to have with us joining the show to sort all that out, the CIO and CEO of Tuttle Capital Management, Matthew Tuttle, who's got some really unique ETFs. You might see the little UFO on there and catch where I was going earlier. But we're going to get into a lot in the markets. Matthew's been an early spotter of trends and themes that you can play for the long term. I think we've got a lot of overlap, but will be a great conversation along the way. Always, you can join the conversation. We had a few Twitter trolls chirping early on, but don't be afraid to hit us with your best shot. We're live streaming on X and YouTube. Don't type in that comment box, are we really live? We are indeed live. Try it, test us, and please come with some intelligent questions, some curiosity. We'll do our best to answer those, address them, and then tell you if we don't know, because we do have a motto here to be humble in the markets, or you'll be humbled by the markets. And a lot of people are learning that this week. So we're going to get into it. We always start each show with the things that are top of mind for me and what we call our rundown, where we give you what we deliver in our newsletter each week. One headline that you should probably ignore because the consensus often gets it way wrong. One key chart that you've got to focus on because the data doesn't lie, and you got to focus on the key data to lead to that one investment opportunity. We want to make sure that this is actionable and ultimately profitable for you, because as much as we love hanging out, even with March Madness and getting some school camaraderie going on, if we're not making money together, if we're not increasing our bottom lines and our intellectual understanding of the markets, then we're not going to be hanging out here for much longer. So please, all along the way, don't be afraid to chime in. We're going to get to this week's rundown right now. All right, I'm usually coming out of here throwing punches at the financial media because they get it wrong. And I got to tell you what, Financial Times, not wrong here. They're putting their finger on the pulse of who profits first from all this panic. And yes, indeed, it is the oil and gas producers in this world. They estimate that if oil stays, and this is a big if oil stays at $100 for the rest of the year, you'll see U.S. oil and gas companies print an extra $63 billion in windfall cash flow profits from all this chaos in the oil markets. Now, that's a huge if, because my last check is it's only March 19th. We couldn't predict that oil was going to go to almost $120 a barrel today. A few weeks ago, we have a president who's predicting 2 days ago that oil prices will drop like a rock. And then 2 days later, 3 days later, he's changing his tune, saying it doesn't matter if prices don't drop. We're going to make money from it because the U.S. now is a net exporter of oil. So what do we make from all of this? Should we be going all in on oil? Guess what, folks? It's probably a little bit too late unless you really love volatility and are trading it with some way to generate income through options. We've been banging the table on the oil and gas industry for the last 6 or 7 months. And this is what happens with contrarian trades. And I'm sure Matthew's going to elucidate this as well, is that things move gradually and then subtly in your favor. But if you look here, the chart on your screen shows that usually a rise and rapid rise in oil prices is a really painful thing for the United States because we were net importers of oil. But we flipped the script with our energy independence about a decade ago. We saw things change, and now rising prices actually are a windfall to oil and gas companies. But I want to be careful. Let's not villainize oil and gas companies, and not just because I work for one, but because you got to think about it. They suffered through lower prices where they weren't making tons of profits, and they've actually been very capital disciplined in returning cash to shareholders by paying down their debt, by increasing their dividends, by also doing share buybacks. So just because they're profiteers in this current market doesn't mean they're also villains at the same time. But I think what's important here is understanding price points. We got spoiled with lower oil prices, and even though Treasury Secretary Scott Bessent's out saying we're going back to $60 and $55 a barrel. No, we are not. I can tell you definitively he's wrong. I'm not. And this is why. You look at the production of U.S. oil and gas, and we've really topped out around this curve of about 13.5 to 13.75 million barrels a day. You look early on through the shale boom in the 2017, 2018, you see that blue line going up, nice steep incline. We're now rounding out the curve, and here's what's happened. Because prices were so low for so long, producers have not been going out and expanding aggressively. That's what you see in these rig counts, right? Those are the number of oil rigs that are active in the field. Now, the contrarian take here is, well, we've just gotten more efficient. Yeah, we have gotten more efficient. There are technologies that are increasing extraction. But here's the deal. You still need more rigs, and especially because these shale plays decline anywhere from 60 to 70% in the first year, 30 to 40, even 50% in the second and third year. So if you don't keep drilling, you don't keep producing. It's hard to keep producing more. And we've showed this chart before that it's not economical under $60 a barrel. You look at the inventory that's available here. If you've watched Landman, you understand this. At least I'll give Hollywood credit. They're getting it right and understanding and explaining the economics of oil. You need above $60 a barrel. You get there and you get multiple years of inventory. You get below $60 a barrel and you're seeing less than 2 years of inventory to drill where it's economical. You get below 50 or close to 50, you have less than 1 year. In the Permian Basin, they're drilling an average of about 4,000 wells per year. So what is the real cost? There's been plenty of pundits opining on the news lately that it's the extraction costs are only $37 a barrel. So we can easily get to the president's goal of down by 50. No, this is not true. This is coming from a survey from the Dallas Fed showing producers saying, where do you need break evens to be? What price is for you to drill in the various basins? And you see the range here goes from about $60 to $70. Keep in mind, this is just break evens. Guess what? There are no landmen and landmen and landwomen in this business just to break even. They're in here to make money. I was at an oil and energy conference earlier this week in Las Vegas, and the CEO of Diamondback Energy, one of the most prolific producers in the U.S., stated very directly, if you want us to grow and you want us to keep drilling and expanding, we need at least $70 to $75 a barrel in oil consistently over the long term to earn our 50%-ish, 30%-ish IRR. So, folks, we can hear it in the headlines that oil prices are going to come back down quickly. They're not. It's not happening, and they can't stay down there sustainably. They are going to be volatile, and I will tell you this, nothing else matters in the markets right now until the flow of oil resumes. The Strait of Hormuz is a critical choke point. So what does that mean? Well, it means our contrarian trade that now has become very popular, the easy way to play the energy resurgence and boom, which was undervalued on an absolute and relative basis to start the year still at about 15 times earnings, is still a great way to play it. I mean, the energy sector is up almost 30% on the year, the best performing sector. Who could have predicted it? Well, we did, but we didn't know when it would happen. So we can't take all the credit. We also want to remember to be humble. Listen, you're up more than 30%. This could be an opportunity to sell some covered calls against this, earn some income. A lot of ways to look to play the energy resurgence. And I'm telling you, it's going to be here for a while. The cash flow, the return of capital to shareholders is going to increase because the impulse for these companies in this space, in this sector, for years has been to be disciplined and not be aggressive growers, because a lot of them got burned during the last oil boom and bust, the last shale craze. So this is going to be a great time for us to be shareholders of these companies, because they're going to return it to us in multiple forms like they've continued to do over the recent years. Now, if prices stay higher in the 90s, I think you'll see exploration increase a lot more as well. But this all adds up to play the trend. The momentum's in our favor for this trade. And so if you're looking to make an investment now, I still think the XLE is one of the best sectors to be invested in right here. You're seeing the likes of JP Morgan, all the other bulge bracket banks come out each day saying this is the individual oil stock to own. I don't think you want to play it that way. There's too much volatility. I think you want to spread your bets across about 23 different companies, leading E&P producers in the country that are leveraged to benefit from this all. So those are the price points to keep in mind. That's the investment to hopefully keep in your portfolio. We're going to have more for you when we come back from this break with Matthew Tuttle, CIO and CEO of Tuttle Capital Management. But before we get to the break and before we get to his insights to share with you, because we know he's got them, we want to learn from those that are more experienced than us. be sure you follow us on all the socials, right? Don't forget, we're trying to be kind of like Mr. Beast. We just want a fraction of his following on YouTube. But this is the way to make sure you never miss an episode of The Big Skinny, which usually airs on Mondays at 5 p.m. But we had a scheduling conflict this week. So we air once a week. You want to make sure you know when that is. Subscribe to our YouTube channel. Follow us on Twitter. I'm not calling it X until Elon follows me. So follow us there. It's a way you can find our insights throughout the week. And with that being said, we're going to come back with a lot more insights from Matthew Tuttle right after this quick break.
I think it's important to know here is that if the oil price was below 60 at the beginning of the year, once this conflict is over and resolved in favor of the U.S., I think there's a chance we can move to a substantially lower oil price regime over the medium term.
So maybe that is the case, Dan.
Yeah, so there's two things going on here. One is the short term. Prices, they're called oil price spikes, not oil price plateaus. They should come back down when hostilities cease. But where do they come back down immediately? So Scott Besson is correct in saying that pre-this, prices were about $60. There's probably going to be a built-in geopolitical risk premium, what we call a geopolitical risk premium in markets, that'll probably boost prices by, let's say, $10. So you may not get back into the 50s or 60s. You may get back to the 70s. But to his point, in the medium term, which we'll define in number of years, with Venezuela off the table and perhaps a friendlier regime in Iran, you could have a substantially lower oil price over the coming years if the oil market reorients itself around that type of an environment.
Bottom line,
completely disagree with that. I don't think we're ever going to get to 50, 60 sustainably because the U.S. is the world's leading.
We were just there.
We were just there, but you're seeing rig counts come down, and if you look at the inventory that's left,
but rig counts are down, but U.S. output is 13.5 million barrels.
Correct, but if you look at the inventory that's left in the U.S., it's not above break even. The economics don't work below $60 a barrel. So could we get back there? Yes, but sustainably, to see the U.S. continue to produce and explore.
You said the economics don't work below 60?
Below 60, you only have about 2 years worth of drilling inventory left. Below 50, you have less than a year. So you need somewhere, we talked about this a little bit before in the green room, the sweet spot with a little bit of premium, somewhere between 65.
You know, some of the big oil companies have already come out and said that's not the case.
No, if you look at Diamondback, they started dropping rigs when we got into the 50s. So I think this is the sticking point between the administration and industry, which I work in right now, is you got to see where the break-evens are. You've drilled the easy, high economic wells, unless we find some new things. So longer term, could we get there? Yes, but
I have 10 seconds, Dan.
Yeah, no, that's right. Depending on your field and what type of drilling you're doing, break-evens could be anywhere from $40 to $60. So I think that's right. You're not sustainably getting back to 20, 30, or $40. But I think the argument is that with Iran and Venezuela and perhaps a more stable world order, oil prices should be in that environment.
You guys did so well doing that, so compact. Thank you so much. We had the breaking news earlier. Thanks, guys. Appreciate it.
All right, welcome back to the Big Skinny, where I'm getting some chirping from my partner in crime here that comes in the Dodd block later on about my Gator jersey. But listen, you got to support your alma mater, especially during March Madness. Just be thankful I didn't wear a basketball jersey and had the gun showing, right? Pale skin Irish guy on St. Joseph's holiday for us Italians as well. So anyway, mixing it up, talking about contrarian trades in this market, contrarian viewpoints, and I'm thankful to welcome to the show Matthew Tuttle, who you probably know because he created the inverse Kramer ETF. So kudos to him. He absolutely knows the trend to follow and the trend to do the opposite of. So I'd like at this time to welcome Matthew. Welcome to the Big Skinny.
Hey, thank you very much for having me.
Yeah, look, before we get to some of your very innovative ETF strategies, I got to ask you, top of mind, it's on the top of any investor's mind that's in these markets day in and day out, is what do you make of oil? What do you make of the war? Do you think the markets can really move on until we get some certainty about what's going to happen in Strait of Hormuz?
Yeah, I don't think we can. I mean, the S&P closed below the 200 day today. We've been telling people for a while, we're so close, we're going to test it. But, until we get some sort of resolution, and that resolution isn't a tweet, it's, it's we're done.
Modern diplomacy nowadays with our administration.
I know. And I think Netanyahu just tweeted something today and the market rallied for about 5 minutes. But yeah, until we get some resolution here, oil goes down, rates go down, it's going to be hard to see the market get any real traction to the upside.
What scared you, right? From a technical basis, you talked about the S&P breaking below the 200 moving day average, but if I looked at it earlier today, the S&P was really only off about 4% since the war in Iran broke out. The NASDAQ about 3%. I mean, that's not even along with the historical norms of a 7 to 9% drawdown during a geopolitical event. I mean, do you think there's a lot more downside ahead? What do you think would catalyze it? And then how do you position to either capitalize on that or really to benefit from the downside?
Yeah, so I'm heartened that we haven't seen that downside. So what you could have seen is we're just selling everything, but what you have seen is we're going to sell certain things and we're going to rotate into other things. As an ETF manager, that's kind of a pain in the ass because I'm like looking at my ETFs and, I'll have half the names like massively in the green and half the names massively in the red. That kind of sucks, but in this environment, there's not a lot you can do about that.
So give me one of the names that's massively in the green that's surprising you and one that's down that's surprising you.
Yeah, it's not that it's surprising me. So, for example, the memory and the optics names. Yep. So like light, we own that in our UFO-D ETF. And that's been massively in the green. I think it was massively in the green again today. It's not surprising me because before the war and during the war, the only real areas of AI that are working are memory and optics. Yeah. So it's not surprising me. And you know what? The gold miners, I think, surprised me to an extent. So, when this war started, the playbook is war, buy gold. So I think that first day gold was up big. Yep. But I always tell people the obvious trade isn't necessarily the right trade. And, gold has been selling off hard. The gold miners I get to an extent because now their costs are higher. Gold, I would say that surprises me a bit, but it was extended.
Yeah. Do you think there's just too much momentum? And I had articulated that you had central banks buying, you had ease of access for retail investors for the first time really in a long time. And then you had the geopolitical backdrop that made sense for gold. You think this is just kind of a consolidation before the next leg higher for gold?
So I do. Yeah. So gold is an area we think you need to own. When all this is over, I think we go back to the debasement trade and gold is something you want to own. Gold miners are something you want to own. We just bought a gold miner today. It had just gone down so much. I got to buy this. This is a great spot. Yeah. I just think it went up too far, too fast. I mean, silver was insane.
Absolutely.
And I always caution people whenever something has a parabolic up move, it's going to have a parabolic down move. Problem is you don't know when, and now gold is having that move.
Yeah, no, that makes sense. So speaking of things going down rapidly, what about software stocks? What do you make of just the bifurcation of the AI trade, particularly as it comes to software stocks? I mean, just getting taken out to the woodshed. Adobe, a company like that, trading at 11 times earnings, I believe, which is kind of historically discounted,
So I think that creates opportunity. I love moves like that because what happens is all of software gets sold off. And like you have stuff like the IGV ETF. So I'm an ETF guy, but I think 99% of the ETFs out there suck because, they're going to give you.
We're going to call you back one time to name names, but we won't do that now. This is the first time.
Yeah. I mean, I've already got a few enemies. I don't need any more. But it includes everything. So people are just sell software. But there are some software.
Let's talk about that then. How do you think about ETF construction before we get into some of your innovative ones, right? So the IGV's got everyone in software. You need to be a bit more particular about that, have a strategy that narrows that. So how do you think about creating new ETFs? I mean, correct me if I'm wrong. I think the last time I showed it on the show, there's more actively managed ETFs or total ETFs in the market than there are publicly traded companies now. So there's endless choices. Doesn't mean there's endless differentiation. So how do you differentiate with your ETFs? And what do you think?
So what you want to do is you want to create ETFs around themes, not sectors, not industries. But if you do create them around sectors and industry, they have to be pure play. So for example, there's a quantum ETF out there that will remain nameless. I trade quantum stocks. They're like 10 names. It's got 75. And you look through, like they've got all of the defense contractors in there. And yeah, okay, Lockheed Martin may use quantum for something, but whether quantum is the next thing or not has no impact on a defense name. So what we want to do is I like themes. I think this market is thematic. We teach investors all the time, you want today and tomorrow's top themes, but then you want pure plays in those themes. So we just launched a space ETF, SPCI, got 11 names in it. Because in space, there's only 11 names you want to own.
All right. So what are the names that you think are that core portfolio that you think is our pure play exposure? Just a handful.
Yeah, in space, it's ASTS, it's Redwire, it's Rocket Lab, it's Blue Sky, Fly. You know, yeah, I mean, names like that. But you don't, like, if you see other space ETFs, they'll have the defense contractors. And yeah, those guys are manufacturing some of that stuff, but they're doing so much else. It's, you know, it's not, you know, it's not going to move a Lockheed Martin, but it's going to move a Rocket Lab.
Do you think those ETF managers are doing it from a diversification perspective, right? They think they're diversifying and controlling the downside by putting, you know, adjacent names in there. And then how do you handle downside risk in a more concentrated thematic ETF?
Yeah, so there's a couple of things, and I don't want to get too far down the rabbit hole unless you want to, but ETFs, there are a lot of rules in ETFs that make no sense. There's a diversification rule, which is one reason why people like to have a lot of holdings. But if you use options or swaps, which we're very skilled at, you don't worry about the diversification rule. I think some of it too is, you know, some people just think more names is better than less names. Yeah. You know, your diversification idea. You know, to me, if I'm giving you access to a theme, I want you to have access to the theme, and then I'm going to let you manage the downside. Now, we're going to give you ETFs to help you manage the downside if you want, and we're going to give you advice to help you manage the downside. But if I give you a space ETF, I want you to have a space ETF.
Yeah, no, that makes sense. Look, I've always looked at ETFs. I'm a thematic investor, top down, bottom up. So I would look to find the theme that I thought would persist, find an ETF that, like you said, your construction has a bit more concentration, pure play, and then own that first. And as the trend gains momentum, look at the individual names in there for a little bit additional exposure. But I found that works out. I mean, you can get 50 to 75% upside in, you know, 9 to 12 months sometimes if you get the theme right. Cybersecurity has been that way. We're seeing that move in, you know, just a more concentrated energy one with only 20 names. What do you see the upside for the space trade? I mean, this is something that is like, for me, is like robotics. It's still a bit out there on the horizon in terms of the compounding effects of profits and revenue growth, but everyone knows that's where we're going, right? We don't need to guess, like that is the future. But where do you think the upside is from here?
Yeah, why I like space, and I love robotics too. Why I like space better than robotics is you've got a decent amount of pure play space names. Not a lot of pure play robotics names. Yeah. And, you know, a company that really interests me is Figure AI, and that's private. Yeah. So from an investor standpoint, you know, so we're kicking around doing a robotics ETF, and they keep showing me the indexes. I'm like, I don't like it.
No, I think Visual Chartist or Capitalist put out a chart showing like who has the most sales of humanoid robots so far. And there's, I don't know, 12, 14 companies on there. I think 2 of them are publicly traded, right? Like, and they have
exactly. So that's why we haven't done robotics yet. Yeah. Space, I love because in the future, hopefully in my lifetime, I'm older than you, certainly in your lifetime, there's going to be a whole ecosystem in space. So what's cool is there's a lot of stuff we manufacture on Earth that doesn't do well in gravity, that does much better with zero gravity. And like, then you look at...
That's interesting to me. What things do well in an anti-gravity world?
It may not be interesting to you. Body parts.
Body parts do well in anti-gravity. So
for some reason,
so it's like a longevity trade. So this is Elon Musk is actually with Neuralink and space travel and colonizing the moon is unlocking human.
For whatever reason, if I am reproducing, you know, organs or whatever, gravity bothers me. Don't ask me. I don't know why that is. I just know that it is. So you've got that. You've got all the cooling that you've got to do down here that you don't have to do up there.
Yes.
The other thing that could be cool at some point is solar energy. The problem we have with solar is we have night and we have clouds. You don't have that in space. But then you're going to have to create a whole infrastructure. How do you get stuff back and forth? How do you defend what you have up there? Because if I have a factory in Indiana and North Korea wants to get it, I mean, good luck. How does North Korea get to Indiana? But if I have something up in space
over our country, so I mean, maybe it's not out of the realm, but yeah, it's a fair point. So you have defense. So I'm curious, the latest buzz was, maybe a month ago where everyone was saying we're going to have data centers in space within like 2 to 3 years. I think that is wildly optimistic. And
I think that's wildly optimistic too. But yeah. I think we will have data centers in space at some point, certainly. And, and because of that, I think we're in the very early innings. And I think when SpaceX goes public, that is going to create a whole new level of interest in space.
So here's an interesting question. We had another guest on a couple of weeks ago talking about the SpaceX IPO. I've argued that most IPO investments for retail investors that don't have access to the IPO shares, right, that weren't pre-IPO owners, it's usually better to wait, let the hype blow off and then come down for a pullback. The way you set up your ETF, do you have to own SpaceX?
No, I'm probably going to wait.
Yeah.
It's going to be tempting because that's going to be, and I've been investing since 1981. That's probably going to be the hottest IPO I've ever seen. I mean, I've seen a lot of hot IPOs. So I say that with a little pause, but so
the hottest IPO you've ever seen, but you're going to pass on it. And that because you think you get a better opportunity to take a bite.
I follow the playbook, and the playbook is don't chase. I mean, dumb retail is going to chase. I don't want to be that guy.
No, I agree. I mean, if you look at the long-term performance, I mean, Dodd, my partner here, hates the Gators because he's a UCF guy, but the preeminent IPO research is out of Jay Ritter out of the University of Florida shows. I mean, that first 6 to 12 months is not usually great performance for these IPOs. But I mean, the question I think and I want to hear your response on this is, I think SpaceX could challenge the valuation limits for publicly traded companies, right? Because it's going to come public at somewhere 2 trillion, maybe already, $1.5 trillion. Do we have to recalibrate how big a public company can get when we look at companies like Tesla? I mean, like Nvidia, Microsoft breaching 4 trillion. Is 10 trillion, 20 trillion out of the question for a company like SpaceX?
I don't think it is, and especially in this market. So I think we've been in an entirely different market since COVID that's dominated by the retail investor. And what you've now seen, especially after GameStop and Melvin went under, is the institutional investors are paying attention to what the retail investors are doing. Yeah. So I'm not going to say valuation doesn't matter, because eventually valuation matters. But valuation doesn't matter as much as it did when I started investing in 1981.
No, I would agree with you. Looking at the market now where Nvidia trades at under 22 times forward earnings and Walmart trades at 42, 43 is just valuation flipped on its head. But before you go, we want to bring up a QR code so people can find out more information on all the funds that you're managing. But I also want to ask you one last question. You are a thematic investor, early to spot things and turns in the market. What's something that's bubbling up on your radar now that you think is really early in the theme that as we get through the rest of 2026 is going to play out and become obvious to everyone else that you're already positioning for?
And that's easy. I mean, that's UFO-D. That's our UFO disclosure ETF. And it's not about aliens. I mean, I always tell people, I mean, if aliens are real and we have their technology, that makes the idea so much cooler.
Yeah.
But, it's really based on something we call the secret gap, which is the idea that whatever we're seeing, the government is 20 to 30 years ahead. And Trump just said that today. He said he was talking to a reporter and he said, we have weaponry. We could end the war in Iran in 2 minutes, but we have restraint. We're not going to do it, which means we're sitting on technology and weapons that nobody knows about. I think we're sitting on technology and energy and propulsion that nobody knows about. And we're positioning in the companies that we believe are going to benefit when that becomes public. And I think a lot of what you've seen with congressional testimony, Obama saying UFO aliens are real, Trump saying we're going to release the files, are positioning us for a release of that technology.
Yeah. I love it. Interesting take, interesting theme to be early and positioned on. Matthew, I want to thank you for joining the Big Skinny. Would love to have you back again.
Yeah, thank you. Anytime.
All right. All right, folks, we're going to take a quick break, but I got to point out, I love that point that there's probably government technology and capabilities that are light years ahead of what we've seen in the public markets, because history tells us that's exactly what happens. The history of innovation is usually driven by government and military defense technologies being developed well before they make it into the commercial market. So completely agree with that thesis. If you have time, check out Matthew's website. We put the QR code up on the screen. Also, make sure you check out our socials so you don't miss an episode of The Big Skinny or an email in your newsletter email in your inbox. So go to thebigskinny.com and sign up for that, where we keep delivering insights. One headline you should probably ignore, one chart you should focus on, and one investment you should consider making. We'll be right back after a quick break.
Lou Basenese joining me this morning. I think that today the price of oil is a more important number than the inflation rate.
It's all that matters right now. But I do think you got to pay attention to the inflation number, because we've got essentially a situation of stagflation light. You see inflation starting to creep higher, but the GDP report this morning showed a revision down to only 0.7% growth. So the Fed is definitely going to hold rates, but they should be cutting. The fear and the cover that they have is that the war in Iran and the price of oil is pushing up expectations for more inflation. As Madison pointed out, right, the core components that are pushing up and keeping inflation hot has nothing to do with energy. It's those other goods and services. We saw really weak durable goods orders. So I think we're in a weird situation right now. The Fed needs to act to get us out of this. Otherwise, stagflation, full-blown, is definitely a possibility.
That doesn't sound good, does it?
No one wants that. So I think, look, everything's the price of oil. You've seen this market completely gyrate as oil swings up and down with stocks.
You with me for the hour?
I am.
So I'm going to pose the question. There's no rally on Wall Street until the Straits of Hormuz are completely open and the oil's flowing freely. Answer that later, okay?
Will do.
See what you think.
All right, we're bringing back the high five segment, but my boy in Southern Florida, well, Central Florida, probably is not going to high five me right now while I'm wearing my Tim Tebow 6-foot lookalike jersey. What do you got for me, Dodd, besides some UCF weird chant that you guys, I don't even know what you do. Do you guys have a football team?
It's not even a chant. I see, there you go. A typical Florida Gator. I have to wear these just to block my eyes from that blue monstrosity you're wearing right now.
I thought those were from the tanning salon, since you go there before every episode, Mr. Ripe and Red all the time. Yeah, rubbing it in.
No, no, I'm wearing my UCF Space Game jersey, which it's kind of sad to say that we both don't own an actual basketball jersey, because we're celebrating March Madness, but we only have our football jerseys.
So you want to hear my funniest story from my short UF career there for about 2 years after getting kicked out of my first.
And everything was short at UF for you, wasn't it?
Yeah, I know. That's what happens when you're 4 foot and under. But the first year the basketball team was actually really good and beat Duke to play Michigan State in the final game of the year, right? With all the bars, if you've never been to Gainesville, all the bars are across the University Ave, across from the football stadium. We're in the bars celebrating the win, and students don't know what to do when the basketball team wins. So naturally, we ran into the football stadium and tore down the goalposts. The police campus police were like, what in the world is going on? We won a basketball game. We didn't think about security in the football stadium. But that also kicked off the end of the times for Steve Spurrier, because as soon as Billy Donovan and the Gator basketball team became the big men on campus, he was out of there. He couldn't handle it. So it is good to have both the Gators and the UCF Knights playing in March Madness. Did you pick them to win? Do you have any brackets? Before we get to the high five, because this is really more important. It's more fun than the markets today.
To be completely honest, no. Basketball, I used to play basketball many years ago, but no.
9.
But no, I don't think, as much as I love my UCF Knights, I don't have a lot of faith that they're going to go that far, but you never know. Cinderella story. Let's go. I don't know. Before this, I know Lehigh was beating Duke by a point or two with 5 minutes left. So I don't know what happened. I'm sure Duke came back and won, but you know, there's always a Cinderella story. So
yeah, well, listen, I have 3 brackets going in our company pool. I picked one that was just based automatic fill based on the highest probabilities, one that was automatic fill based upon how other people bet, and then one that was just completely random. And then I just made sure I went in after that and made the Gators be the #1. So that's the only adjustment I made. So
wait, you made the Gators be #1?
Not, I mean, win the whole thing in all 3 of those brackets. So that'll probably ruin me. But
well, that was just the dumbest thing I think you've ever done. I
all
mean,
right.
I mean, really? You might as well. Did you pay money for that bracket? Could you just threw it all away?
$10, man, $10 each. So speaking
Let's
of
hope that your advice to our viewers, you know, and insights are smarter than your bracket pick for the Gators to go.
Listen, the only time I played fantasy football, I did auto draft and won the whole thing. So anyway, speaking of dumb things that I do, there's dumb things that politicians do, and now it's leading to, you know, play stupid games, win stupid prizes. California, bye bye bye, and Sync is the theme song for billionaires. Getting to this week's high five, just an exodus. I mean, we were reporting in the news. I think Forbes had an article, someone did, that about 6 billionaires that have fled California since they anticipated imposing the wealth tax. My count has it at more than 6, and a total of $1.7 trillion of wealth that has just left the state for lower tax states. This is not good. This is a precursor to what's going to happen in New York City if some of the tax proposals go through. And we're seeing this play out throughout the country. That's why your real estate is so expensive down in Florida, my friend.
We're all moving to Palm Beach, brother. I think that's where everybody's hanging out these days. That in Texas, right?
Watch out. East of UCF, Christmas, Florida could be the next big town, man. Christmas, Florida. I'm making the prediction.
I highly doubt that, but you know, that sounds like your prediction for the Florida Gators to win it all in March Madness. So
I can't wait for them to win. You're gonna have to eat some crow. All right, moving right along. Recession fears are mounting again because why? Because oil's up, which could really hamper economic growth. I will say this: when we look at the recession fears, you got to think about how the impact on higher prices will be in terms of energy. And over time, because of energy and efficiency, technological advancement, and yes, some of the climate change initiatives that forced transition to different types of motor vehicles, electric vehicles, etc., the average consumer is paying less for energy. So the impact is not going to be as severe. We've talked about this on air and debated it a bunch of times on Fox, going back and forth. The rate, how quickly oil prices rise, sometimes is often a very good predictor of recessions. That's why everyone's freaked out because we've gone from 60 to 120 in a blink. But I would argue that if we have a recession, it's going to be like a whiff. It's going to be very, very short. I don't think the duration will be long, but I don't see any signs of that yet. So it's something we're monitoring. I
think times are different. Times are different now. So
those are 4 dirty words. It's never different. It's never different. So inflation, again, another concern that is gripping the markets, right? The Fed could be in a weird position where the labor market has weakened, which we've highlighted here, but inflation is picking back up because of oil. Guess what's happened now? The investors, the odds makers have now bet. We're counting on, maybe a month ago, 2 to 3 rate cuts this year. Now there's actually a probability of a rate hike before the middle of the year, before June 30th. What do you make of that, man? What do you think if your interest rates went up? You've been in your home forever, but how do you think that sells for Main Street America here, that's worried about credit cards and auto loans and mortgages?
I don't think that's going to be a good thing, man.
It's not. You're right. But here's what I know. You know what's a good thing? It's often a good thing to bet against these odds makers because they're seldom right. If you go back a year and a half, they were predicting like 5 or 6 rate cuts back in 2023. That didn't happen, or 2024. They weren't right. So this is something to monitor too. The market's moving. This is what we talked about earlier with Matthew. Being early to trends means being attentive to the trends as they're playing out, the data as they're playing out. So we want to pay attention to what's going on here in the interest rate world. You also should be paying attention to AI layoffs because we're all doomed. We're all going to be out of work in 6 months or less.
Or everybody's blaming AI again, right? Let me guess.
Yes, they are. It started with Jack Dorsey, who I used to dog for being a two-timing CEO when he ran Twitter and Square at the same time. He just, 2 weeks ago, or a week and a half ago, he was in the headlines because he was cutting 40% of Block's workforce and blamed it on AI. I call a bullshit because Jack Dorsey has there we go. Right on cue, Dan the Man Levitan. Jack Dorsey has a history of doing this. If you look at X, he went from a pre-COVID hiring to when Elon Musk took it over and doubled the workforce. He just overhired, overspent. He's just a bad manager. He's a bad operator. And guess who else is? It turns out it looks like Mark Zuckerberg, because now it's making headlines that Meta is going to lay off up to 20% of their workforce because of AI. They're blaming it on AI. But look, once again, Zuckerberg, if you remember back to 2022 and 2023, after the peak COVID hiring, they fired about 22% of their workforce. So I'm seeing a lot of twos here. They've both been double timing CEOs and cut twice and overbuilt twice. I just think they're bad operators. And then here's not just that. Those aren't anecdotes. There's this new study that is out that actually hiring managers have confessed. They surveyed 1,000 hiring managers, HR managers, and they confessed that in 59% of their firings, they blamed it on AI, when only 9% of those cases were actually because of AI.
So AI is like the new, the dog ate my homework for CEOs. It's like you got to blame it on something.
Yeah, accountability is supposed to flow up in corporations, and the CEO should take the blame for, hey, I incinerated $80 billion on this metaverse and made it meta worse. It's my fault. No, instead,
hold on. You're jumping ahead.
Instead, we're just going to blame AI because it's convenient.
Yeah.
All right. Apple. What do you got here? It's
fanboy alert. So this is basically Apple doesn't need to innovate. They just need to iterate, right?
They do. And this is proof. This is the chart that I just need to usher out every time everyone says, oh, they need to innovate or they're going to die. No, they're not. Not even close. They now, Tim Cook revealed at the beginning of this year, Apple has over 2.5 billion devices circulating in the wild. That is enough installed base where if you get a few pennies more, or maybe another $1 more from your iCloud subscription, or $8, or whatever Apple TV runs you now, it adds up and adds up substantially. So much so, if you look at the right side of this chart that someone beautifully made, Apple's single line of business for services is greater, single line of business, not the rest of their business, not hardware, is bigger than Verizon, Tesla, Disney, American Express, and Nike, all of them individually. So just massive size and scale here. All you got to do is iterate, earn a little bit more, buy back stock, return stock to shareholders, cash to shareholders, and keep coming up with new things to roll out and more.
So is there anything that Apple could do wrong? In your eyes?
I don't think there is, but we've got a comment. So someone thinks maybe we're doing something wrong. Let's see what we've got. The old reminder here. They're going to be fleeing Washington State too. The founder of Starbucks. Yep. Howard Schultz has left for Florida, and Starbucks, the company, is moving to Tennessee. This will not stop, friends. This is not about politics. This is all about mathematics, right? It just is. I mean, look, you live in Florida. I've lived in Florida, Tennessee. I considered Texas and Nevada and Washington because they're all income tax free states. Yeah, say that 9 times fast. Look, it's
your Florida Gatorness coming out.
Yeah, it is. Yeah, Alachua County, baby. Here's what you got to remember. The thing that is most damning here, and that's why that California chart in the beginning, I think, will just continue, is the politicians are arrogant. They think that people won't leave and it's too late. Capital votes with its feet. It doesn't vote and wait for elections. They're moving out. So absolutely. Washington State, the exodus has now begun. Howard Schultz kicking it off. And the irony there is, like, he really started some of the most progressive policies in corporate America with that company. But anyway, Callie, bye. I know NSYNC was one of your favorite Spotify playlists, my friend.
Still is. What are you talking about? Was. Absolutely, baby.
All right, we're saying bye to this block with 12 minutes to run on the clock before we get to what's next. And remember, follow us on socials. And as you see, we are live streaming on X, YouTube. Don't be afraid to chime in on what we're talking about. Add some insight, show your expertise. We're not afraid to feature you here because we know We don't know it all. So if you've got something to share that's relevant, we'd love to hear from it. Yes, dividend degenerates, go Gators. Dodd, eat it. I hope we play you guys. I don't even know if it's possible in the bracket, but we'll be right back after a quick break.
Taylor Block, dividend degenerate from here on out.
Mute his mic. He can't say anything. It's not allowed.
This is like a tale of two different stories. So first up, Lululemon forecast profit and revenue below estimates. They had to bring in an executive from Levi's because the founder, Chip Wilson, is in a huge proxy fight. They're trying to find a new CEO. Macy's brought in their new CEO, Tony Spring. He's actually, I'm thinking, the market's thinking, bottomed out in the big turnaround for Macy's, trying to find a good future forward. So these are big turnaround companies. I think today Macy's is ahead of that, and Lulu is in the middle of their fight. Thoughts?
We call him Lulu sometimes.
Yeah, please. Little Lulu was my dad's nickname, and that's why he called me LJ. But
what's going on?
Look, I think retail's a tough place to be in. It looks like that all these apparel makers are in a turnaround, right? We talk about Nike trying to get back and become relevant. I don't think this is a spot in the market I want to be with prices increasing, the consumer being strapped. I was at an energy conference yesterday, and the CEO of Diamondback said, look, you got to get used to $70 to $75 oil because that's the only place we're going to drill more. So $75 oil means higher consumer prices across the board. It's going to hit companies like this the most, in my opinion.
All right, we're back for one of our mainstays, our staples. The high five got replaced originally by headlines and head scratchers, but we resurrected high five. But I love this block. This is where we admit our stupidity sometimes, or you do, and then I have to. Just kidding. You've been making fun of me for being dumb, so I had to get you back once.
You know, it's not all stupid. There's also things that, actually, make us look good too.
Yeah. You're right. No, we try and be honest in evaluating ourselves here. What do we get right? What do we get wrong? What did we just totally not see? And then how do we learn from that? Because that's really the point of this is we're trying to increase our bottom lines, and that requires being perpetually curious, but then also humble to revise. So I can't say that about the first thing in our headlines and head scratchers, the person behind this.
The first one is What the Zuck, which is the metaverse was going away yesterday. And then today, actually, there was news that came out that said, no, we're going to keep it, but we're going to keep a version of it just for our current users. So they spent like 800 billion or 80 billion, something 80 billion to create the metaverse, and then poof, gone.
Yeah, incinerated. That's why they're not getting rid of it. It's the metaverse because they don't want to accept failure here. This was a tragic call. I mean, then here's the other thing too. It's an existential question. What do you call yourself if you get rid of the metaverse now? Remember, the company pivoted entirely when they decided to light the first 39 billion in capital on fire developing the metaverse, and then renamed themselves Meta. Come on, man. I would have rather they went back.
Going back to Facebook? Is that what we're doing?
They're not going to change. No way. I would have rather they resurrected MySpace and renamed the whole thing MySpace. But that's
you want to hear an odd fact, and this is probably I have no proof, and you probably won't believe me.
So then it's an odd fact. It's not an odd fact.
It's a Dodd fact. So I want to say probably about 10, 15 years ago, I swear I had the idea for the metaverse, but it was university. And it was the concept of basically creating that type universe where individuals could come around, look at that, could come around and interact with each other as avatars and doing all that. So, of course, I had zero funding to actually pull that off, which, totally took the idea and threw it down the toilet.
Zuck had 80 billion to burn. You should have reached out to him. He would have given it to you. Look,
I guess I just saved myself 80 billion and 15 years of pain and suffering. So I guess that's
good. I've made no bones about my disdain for Mark Zuckerberg and all things that he stands for on Facebook, because I think he puts profits over principles and has forever. I don't think he has any principles. He has definitive and had pre-knowledge about the debilitating effects of social media, particularly on preteen girls. He knew about fraudulent advertising that was happening, that was taking advantage of octogenarians, which are the old people, and didn't do anything about it. Just proceeded ahead because he could make too much money off of it. So much so that he could light $80 billion in capital on fire, completely waste it on a universe that doesn't matter to anyone, and still get away with it and be the CEO of this company. I don't think there's any other public company in the world whose board would stand for this type of just blowing capital. But look, good thing is we're not a big deal on Facebook or Instagram because we're never going to be. So,
now, did I understand it correctly? I read somewhere that part of the reason they got rid of the metaverse is they couldn't police it enough because of, who said they were who and what kind of, bad stuff was going down there. Is this a PR like, hey, no, we're doing good in the world? Is it?
Nah, I don't believe that. That might be their PR spin for this. I just think they had to burn it down and burn the Capitol because no one else was using it. There was no utility.
It just wasn't successful.
It's the classic, Michael Schumpeter's chasm of innovators, right? You get to a little bit of market share, and if you don't cross that 20%, you're never going to make it. And the metaverse was doomed from the start. But, good old Mark Zuckerberg, he lives to fight another day. Anyway, IP Doe. We move along.
IP Doe. Okay, this builds right off of our episode, the beginning of the year, our predictions, our 6 predictions. One of our predictions was that you never buy an IPO out of the gate. And, you just spoke about that with Matthew about the SpaceX IPO and how, it probably is not a good idea to do that. So Bumble, basically started at $60 and collapsed 90% in textbook post IPO fashion, and now it's, I don't even know, it's in like $3-6.
It's in the basement. It's in the basement where all the I don't know. I was going to say something derogatory. I'll keep my mouth shut on that one. But I would say it's in the basement like most IPOs. You look at Peloton in the basement, Beyond Meat's in the basement. Most of these IPOs end up down 90+% because they come to the market with so much hype and such a high valuation. There's no way they could ever grow into it. My classic example here, do you remember Zoom? Because we all Zoom now, right? COVID.
Oh,
during
yeah.
the peak of the COVID highs, Zoom Communications was trading at a market cap of $46 billion. Now, every study out, $46 billion, but here's the kicker. Every single study out there has said that the market for video conferencing, basically every possible customer, if Zoom owned them, had them, subscribed them, would only be $24 billion. So it was trading from almost double the entire market if they owned it. It made absolutely no sense. Sure enough, that was the easiest stock to short in the world, just like Peloton. I will confess, because I am not a genius, I bought a Peloton. I rode it once, and it sat in my room and was a great clothes rack for a long time before I gave it away. So biggest waste of money. Stock. I tried to give the Peloton away on a Fox Business panel when I was debating a guy that said Peloton was going to rebound and be one of the greatest investments, and I'm like, I'll give you my Peloton, and I guarantee you it's not. So
did it work? Did he give it away?
It didn't, but this is how do we bring this back full circle? SpaceX IPO going to be probably the largest, most valued IPO ever to hit the markets. Not going to be one of the best investments if you're looking to buy on that first day.
Especially as a retail investor, I would assume that there's plenty of insiders that would get in even early, or is that really just the evaluation is going to be
it's not even that.
high from the start? It doesn't matter.
It's going to rally out of the gate because people are just going to bid it up. So unless you get access to IPO shares, I don't even think there's you just don't have a prayer at making money off of it trying to buy on the first day.
Way too risky. Yep.
Yeah, that's an easy prediction to make, a layup based upon history and just evaluation. So moving along, less
transparency. Okay, so the SEC is considering scrapping mandatory quarterly reporting, which could dramatically change how often companies update investors, which basically means for us normal investors, we'll get information instead of quarterly, maybe twice a year?
It'll be every 6 months. So this is typical in many international markets that you see they're only required to file quarterly reports twice a year, an annual report and then a mid-year report. I don't think it's terrible. I think this actually has some merit because it forces investors to be a little bit more longer term oriented if you're not going to get an update on the business. People do worry about, well, what if they hide information? They can't. Publicly traded companies have a requirement to disclose material business changes within 4 business days. So this is not about them being able to hide poor results or bad developments for up to 6 months, but it is about cutting back on the accounting and auditing and just a lot of the prep work that goes into this. Being on the inside of many public companies, I think this could be a good thing because it frees up those resources to actually run the business, project it forward, and force investors to be a little bit longer term minded. But I also think it's great for us, man.
I was going to say, I think it's going to help us, who's helping that information along, but then also put it more on the individual investors too, instead of waiting for that quarterly report to do their due diligence on a monthly or weekly or whatever basis. So,
yeah, you got to find. So I think they'll have to find new ways to communicate and reach investors. Yeah. And man, the big skinny's not a bad way to get started. So I think it's got pluses and minuses. It'll take away a little time to make its way through the SEC, but definitely something to be keeping an eye on as this year unfolds. Similar to the no buy zone for what we're going to talk about. Keep your eye on this.
No buy zone. So airlines are getting squeezed by a jet fuel spike. So travelers are likely about to eat the higher cost through pricier tickets. So obviously this Strait of Hormuz and all this, energy crisis that we're in is affecting travel. In addition to, just side note, the travel craziness that's going on just from Homeland Security and lack of funding there and all that, 5-hour waits and stuff, but separate subject.
Yeah, all the problems stem back and go back to government. No, but listen, airline stocks are terrible investments. I very seldom have ever recommended them. The problem here is 20 to 25% of their expenses and costs come from jet fuel. If oil goes up, their prices are going up. And guess what? They aren't profitable unless they pass on those prices.
Who's paying for it?
Yep. Yeah, we're paying for it. Consumers pay for it. So it's a bad break both ways. It's a bad break if you want to buy airline stocks that are not going to work out, and it's a bad break if you want to travel. It's just going to get more expensive.
It's a great time to enjoy car trips. So
yes, unless you have 19 kids like you, I don't know how you fit them into a van. So
yeah, I've got 19 kids and 0 that like car trips. So actually, no, I have one. I have one that likes a car trip.
Awesome.
But anyway, that's a story for another day. Let's see.
All right, man. What's last?
I fold. So, this.
You're folding. UCF's done. You're going to fold?
I fold. Yeah, exactly. Yeah, I fold. This iPhone foldable phone, are they chasing Samsung here? Is this, you're the Apple fanboy.
Who cares? This is so.
It doesn't matter. Is this just all noise? Because obviously the Galaxy is like, it's like only like 2% of sales of foldable phone, or 4% of their Samsung's phones is this Galaxy. Why are they chasing this niche?
I got a foldable phone right here. Here it is. Look at it. It's my foldable phone, folks. My Apple foldable phone. Like, who wants a phone that does this? Like, just get an iPad.
I wanted your take on this. Are you buying one of these?
Your iPhone Pro is like 6.45 inches big screen. Like, what else do you need? It's called a computer.
Dude, I'm 6'7", and I've got this thing, and that's all I need. I just need. It's got
the size of your head. That's ridiculous.
Got my Lando Norris screen for F1. Love that.
One crazy. Here's what I would say. I don't think it matters. This is an incremental copy. It's not an innovation. They're just following Samsung. There's enough of a market there. They'll make good money off of it. I don't think it moves the needle. It's not a development that I think that matters as an Apple shareholder, but. Not everything can move the needle. So they're just kind of meeting the market demand. Classic business fundamentals, give your customers what they want. Apparently.
So is this classified as iteration or innovation? Not innovation, clearly.
I don't have a word at the top of my head for it.
So you're not a fan.
I'm trying to combine like idiot and Asian, and that's ideation. And no, that's not getting there. So I don't think it's a big deal, but it doesn't dissuade me from my bullishness in Apple long term. So yeah, Apple stock, give us better than a month. Now Apple,
go back to the month.
Apple is actually one of the Mag 7 stocks that has performed the best through this downturn. It is, I think.
There you go. Now we feel
NVIDIA might be one that's actually up. But anyway, we're running out of time. We're going to close it out with a final thought here. So I'm booting you out for one final thought that I think is relevant in these markets. But before we go, man, I want to thank you for being a good sport, for dealing with my Florida Gator fan.
It's tough, man. It's tough seeing you in that Gator jersey. I got to be honest.
Oh,
but it's okay.
Get used to it, because your nights are going down and we're going to be in the tourney for the whole way through.
Well, I'll agree to the first half of that probably, but the second half, would you like to make a bet that you probably won't pay on?
No, I won't. I won't pay on my bets to you. We can bet a quarter. That's it. So,
all right.
No, before we go, I saw this great comic and it really made me laugh, and then it made me think of one more chart to show before we close out. We try and end before you run with a final thought that'll carry you through to the next episode. And this week, this comic said, what a week, huh? Captain, it's Wednesday. Well, folks, it's only Thursday. We're going to be feeling this. With the war unfolding in Iran, going much longer than I think anyone's anticipated, I think there's just a lot of anxiety, panic, just exhaustion in the markets. But here's the one thing I want to leave you on. There's nothing we can do about that. There's nothing we can do but recognize the emotion and not be scared stockless. And here's why. Every major geopolitical event outside of two has led to stock prices being higher 12 months later by an average of 14.2%. So if you look at the dynamics at play in the two instances here, the backdrop, the underlying fundamentals in the market back in 9/11 and 2001 was not amazing. If you look at the backdrop following the Ukraine invasion, several years ago, it was not amazing. The earnings growth was really concentrated just in the Mag 7. That was propelling the stocks higher. And now in this current market, we're seeing much more broad just success across the market. So when this passes, as it will, I think there's going to be a lot of opportunities in stocks. I think they're developing right now. So we're going to do our best to keep you informed of the best ways to profit from the chaos, the panic, and the scarcity of opportunity at times. But there will be abundance another day, and we'll hopefully be ones celebrating abundance with you and more profits in our portfolios over this end of this year. So we're not going to think that far ahead. We're just going to think to next week. We'll be back Monday this time at 5 p.m. at our regular right time. Thank you for joining us as always. Make sure you follow us on socials and make sure you sign up for our newsletter at thebigskinny.com. I'm Lou Basenese. Go Gators.